Good morning, traders. It is the weekend and it is about to come to an end. Well, it's early Sunday morning here, but in Europe and Asia, things are getting ready to kick off in about 10 hours. It was an interesting week of trading. Mostly the markets fluctuated with expectations of and then expectations of diminishing of quantitative easing based on data and reports that came from various Fed members, and with the data points, basically the FOMC meeting minutes from last August came out very aggressive, and it looked as though quantitative easing was right around the corner. But then and this pushed most of the majors up, and then on Thursday we had Fed Speaker Bullard coming out. Fed member Bullard coming out and basically saying what I had actually stated in the reports I sent out, that the minutes from last August were a bit dated, and they didn't reflect the current economic environment with the data releases that have been released, and it's shown stronger jobs growth and so forth. So now what we have, and we had a drop heading into Friday, and then on Friday afternoon we had a letter revealed from Bernanke to a member of Congress that actually sent the pairs back up, where he defended the use of quantitative easing. So I think this is the kind of trading that we're going to have for the remainder of the week heading into Jackson Hole on Friday. Basically the markets are going to be skittish, and they're going to bounce up and down with every little piece of information or rumor that is going to come out that's going to make the that's going to have any impact on what's going to come out of Jackson Hole, or how much quantitative easing there's going to be. I mean, there's different points of view. One says that they might announce a small bond purchase program at Jackson Hole, say like $150 billion, and then the other point of view is they might go all in and announcing a huge program where and maybe not even have a definite end to it, where it's just going to be, we're going to check every 6 months and see if we need to keep going. And my current expectation is that we probably won't get too much out of Jackson Hole, and the reason being is that the European crisis could definitely spark up again, and I would assume that they're going to have some more bullets in the chamber to do something, and that's something would be, I mean, if they've already done everything that they possibly could and things start to worsen in Europe, what are we going to do over here? So what we could see out of Jackson Hole is maybe the announcement of a smaller program, an extension of maybe the expectations for interest rates to remain lower for an extended period, for even longer than was it 2014 and 2015 or so forth. And I mean, but there's really no way to predict what they're going to say. You can just watch the markets and let's try to make money off the jumping around. And there's a few things that could cause a little bit of volatility this week. The beginning of the week, once again, is rather quiet. We don't really have anything coming out on Monday that's going to be market making. On Tuesday, out of Japan, we have a monthly economic report. And then the markets go somewhat quiet again. The bigger data out of the U.S. is we have consumer confidence on Tuesday, and then again we have the GDP on Wednesday. The GDP on Wednesday could it's supposed to come in at 1.6. If it moves above or below expectations, that could definitely have an impact. And then we have the beige book also on Wednesday, which could give us definitely give us a little bit of insight of what the Fed's thinking about. And then of course we have Jackson Hole on Friday, and then we have out of Europe. Let's see, out of Europe the markets are kind of quiet, except we have unemployment on Thursday, and we also have the consumer price index coming out on Wednesday, and that's it. But what we're going to more importantly be watching for is any rhetoric from different members of central banks to see what we have. And of course we always have Europe that can always cause little fireworks, because in Spain It was rumored last week that Spain was in talks with the ECB about the possible ways to structure any kind of debt renegotiated debt plans, and this caused the euro to shoot up. And then later in the day, it was sent out that was false. It made the euro go down. Basically, we're trading in thin markets, and any kind of euro, any kind of fact or fiction that can make the markets move around. You always have to watch for whenever Merkel is speaking, because Merkel can move the markets at a whim by just giving her views on what she thinks that the Bundesbank should do and how Germany should act to maybe allowing euro bonds in general. All right, let's go through the majors right now and get a rundown of what I'm going to be looking at and to start the week and all the different pairs. We're going to start with the Euro USD. The Euro USD, as you can see, throughout the week basically climbed the ladder of fear, and it continued to squeeze higher throughout the week, and just knocking out weak shorts. And that's kept fueling a steady move towards the top. This could continue into this week because most people are going to want to short this pair heading into the news on Jackson Hole, I would believe. And then whenever positive data comes out, these shorts are going to have their stops just above current ranges, and it continue to fuel the short squeeze higher. It's basically walking the wall of fear higher. But heading into the beginning of trading, or let's just look at on the entire week, you can see that the euro is in a triangle right now, and this top of the triangle is created. If we'll look on a daily chart, it is created by this downturn, this descending trend line that has capped all the price action to the top side since last October, and this will be a formidable level if the pair gets up to there in the beginning of the week to crack through. Now on the bottom we have this is an ascending trend line, and it's just from the move higher from the beginning of last month. So if we get a break of either one of these levels, we could see a bit of momentum into the beginning of the week. But what I would expect, to be honest with you, is that the pair will remain range bound between these two, the top and bottom of the triangle, until the Jackson Hole agreement. But levels we will watch going into the beginning of the week is I'm going to keep my eye on the 125.60 area, because that's the high for the end of the week. But more importantly, I'm going to keep my eye on the weekly high at 125.90. A move up to this 125.90 area might find sellers in the short term, and you could place your stop. They could place their stops right above here in the descending trend line, maybe at the 126, say 50, 60 level, and they'll look for a run down to the bottom of the trend line, which would come in around 123.40. That would be a trade that I think would spark a lot of interest, and even if we get a pop above this up towards that trend line, would be the same. You could do the same trade with maybe just even a shallower R&R, but the problem is you might not get the trade. Now, if the pair moves down towards the 124.80 area, it is very possible that we could pop below, and I don't have too much confidence in these resistance levels. Maybe a 124.80, 124.30 would be a better level that you could consider going long into. But if we break down all the way down to the bottom of this channel support, that would be another excellent place to put a long and have your stops just a little bit below for the risk reward. What I'm going to expect into the beginning of the week is to bounce around in this triangle, maybe not all the way to the bottom of the triangle, maybe bounce up to this top, down, top, just consolidation. And then when we get to Friday, whether the channel is going to be narrowing, or maybe before Friday, maybe on Thursday, we'll pop from one side, and we'll probably have a false break or two on the way. So watch for consolidation and any move up towards the top of the range to look for a pushback down, and to start the week off. The Great Britain Pound USD, still playing the same game. It's actually very interesting. It did break higher. It finally broke above the 50 fib into the end of the week, as we've been talking about for that level, the 50 fib from the May decline at 157.82, had capped any price actions to the top side for over the last few months. And now the pair broke higher, and it didn't waste any time. It went right up to the 0.618 fib at 15904, and then it promptly reversed. And now it's going to come back down, and it's back. And on Friday, it broke the weekly range, or the daily price support, and it continued to move down. Where actually many pairs bounced higher into the end of the. Most of the pairs had a little bit of a bounce. The euro did. The Great Britain pound did not. It finished the week at its lows for Friday of the day. And now we're going to look for another move down towards the 50 fib at 157.82 to see if we can get a little bit of traction there. If not, we could go down to the 156.60 level, which is the 0.382. The way I'm going to expect price action to occur this week, it's going to be all about watching these fibs. I'm going to watch the 0.618 fib at 1594. I'm going to watch the 0.382 fib at 156.60. And we could very well see the pair just move around here, and the 157.82 50 fib act as a pivot. And you move out to that level, you watch the price action. If it holds, we could get a bounce back to the top. If it breaks, we could get it moved back down to the bottom. And we could see this continue to play out throughout the week. Now, if we get a break above, though, a solid break above the 159 level, the pair could be on its way back up towards the 160.50 area and the 159. But the way to watch it is to play the range. Play the range into the beginning of the week, and that's basically the monitor and what we're going to be saying throughout most of the pairs. And the next one we're going to look at is the Aussie USD. You can see the Aussie broke below the trend line, that channel that had held it up, and broke through the bottom trend line, but it didn't really get much momo through the break of that trend line. This happened at 3 o'clock in the morning Eastern time on Friday night. It shot right down towards the 103.80 level, but then continued to move up. What I'm going to look for in this pair is I'm going to look up for a move up to the 104.35, or even better would be the 104.50 level in this area. Then we can, if it gets into this zone right here, I'm going to call this a pivotal area, but this is also where we could definitely have sellers come in and look for a move back down to the 103.20 area. So if we get any move into this zone, sellers could emerge, and I'm going to be looking to go short right there. Because we have strong support with a daily price support, and we have the channel top going right now. And if you can look, if you want to get even more specific, if you look, we can get right now, right here, the pair is hitting the bottom of those lows for the week that it broke through on Friday. It could be also, you can say, if it closes, stays firmly behind this, we could see another move down to 103.20. But I don't like that trade as much. What I'm going to be looking for is a move up to test that channel top, like I just said, and look for a support. Look for a little bit of resistance here and a push back down. That'll be a nice trade to start the beginning of the week. Now, if we do break back up into the top into this channel, you could definitely expect another test of the 105.30 area. The New Zealand USD is all about these resistance and support zones. As you can see, over the last few weeks, the pair, starting in the last month, the pair just basically bounced around between the resistance zone between 78.60, support zone at 78.60, and the resistance zone at 80 and 80.35, and then finally the pair broke up and then ran very quickly into its next resistance zone at 81.80 and 82.35. What we're going to watch in these pairs is you can see it's riding in the beginning of the week. It's been riding this channel slowly higher, gradually higher. I'm going to look for any move into this resistance zone, 81, 80, 84 to 82.35 as an opportunity to short the pair. Now, I'm not going to want to. When you could go short right when it just touches the top, it touches the beginning of the zone. I'm going to look for a stab into the zone and then go short and then put my stops above the top of this zone, and now we're looking for a move down to the bottom. And then if we get the same thing, this is going to tell us if we get a break, go to hold here, we're going to move back up. If we get a break between this is the pivot level, get a break below, we could be heading towards the bottom of the range. So these trades are pretty well defined for us, and as long as the pair remains in these ranges, we can just play the bounces inside and out. It's basically short-term scalping, but you have to play with the market's giving you currently. The CAD USD is interesting. the CAD find a little bit of traction right at the bottom of the range. You can see, if we go back on this chart here, that the CAD basically for between February and the beginning of May consolidated in the shallow zone, constantly testing the 105.50 level, then coming back, and the one actually did go as low as 98 before it reversed and moved all the way up to the 104 and tested the top of its channel. And since then, the pair has been coming down slowly but steadily. Now, with this pair, of course, you have to watch oil prices, because that's basically what's been fueling quite a bit of this climb. Because when the other majors go up, the CAD would rarely move much higher. But what we have here now is the pair is back in the consolidation zone. So the only way that we're going to play this is basically play the same exact zone. The top of the consolidation zone was a 10050. So a little bit above parity, and the bottom was at 98. So what we're going to look for is for the pair to bounce around in these same levels. Now the 0.9950 level could in the short term could act as resistance to start the week off, and if we get a bounce off there, we could be going back towards the 98.40, and any extreme would be the 98. So this is kind of like another support zone. If we get a move down there, you could go long, place your stops a little bit outside, and look for a move back up to the top. But what I'm really looking for is not so much the parity line here. I'm not too interested in that at the current moment, because it's more of a psychological line. You can see that the cross did bounce off it, or it does kind of hold around it. But more importantly, for the better risk reward, be any move up towards the 10050 level. And a move up towards the 10050 level would be the beginning at the top of the consolidation zone, and you could look for another bounce down. And we basically look for this moving around before the beginning of the FOMC meeting minutes. Now there is a little bit of data out of Canada, and basically let's look here. We have is there any market moving data? I believe there's data on Friday. Yeah, next Friday. But this is going to be overshadowed by Jackson Hole. Canadian has a release of its GDP report, which is expected to be around, I think, 1.6%. But that's going to be overshadowed because that's only coming out an hour and a half before the Jackson Hole meeting. So basically, watch for this pair to move along with risk and oil prices in general. And in the beginning of the week, watch the 99.50 level for an indication of what we have going. And if we get a hold there, we could go to a push to the lows, and you move up towards the 10050 level. That will definitely present a selling opportunity. The yen is basically moving, as we've said, with treasury yields and expectations of further quantitative easing. Basically, if the Fed puts on hold quantitative easing, treasury yields should rise gradually, and we'll see the yen appreciate. Basing on what happens if we have some great release of further easing in the economy, we could see the yen move down, and the yen can move down to test the yearly lows. Now the problem with the yen in these levels is that we're back in intervention territory, and you have to be careful after we have the Jackson Hole meeting and so forth in the next week or so, that the Japanese government could pick up its rhetoric and actually start intervening, or at least verbally throwing out the possibilities that they will intervene. So heading into the week, what we're going to watch for this pair is it's going to have the biggest moves to any news or rumors coming out about possibility of changes in the U.S. plan. But we're going to watch the 78.70 level, then the 79.15 level, but more importantly, we're going to watch the top of the range at 80. And basically, I'm just going to watch the tops of the range. If we get a move up towards the 80 level, there could be a chance to short it. Any move down to 78 or 78 would be a good opportunity for the risk reward. Look for a drift back higher. Move below 78.70. You could go long, looking for a gradual, slow move up to the 79.15 and 79.50 level. With this pair, you have to basically watch the short-term moves. I mean, it could ultimately just reverse right here at the top of the range, 78.70, and slowly drift down towards 78. But you have to watch for any kind of short squeezes with the information coming out. Let's look at the yen pairs a little bit quicker. As you guys have heard, should have heard is that now a few times a week I'm putting out yen reports where I make a video, like a 3-4 minute video, and I just quickly go over the yen pairs, and then I throw the charts on the website too. And this is for the members. It's called Yen Talk, and that's where you can find all the information you need about what I'm looking at and how I'm trading the yen pairs. And of course, on my Twitter feed, I'll tell you about any trades that I'm currently looking at or trying to get into. Let's look quickly. The Euro USD, it broke, as we said, it was in this wedge. It broke below the bottom of the wedge, touched 98, and then it couldn't gather much momentum to the downside. Right here, right now, would not be a bad opportunity if we get a pullback into the beginning of the week to go short once again, if you're not already short from these levels right here. If we get a pushback up towards, like, say, the 98.60 level, you could go short there, looking for a push down towards the 98, the 97.80 level, if you want to hold for a more aggressive move down to 96. But I would expect this pair to remain, I expect all pairs to basically remain range bound at the beginning of the week. So a move up towards 98.60 is a very good opportunity, and set your risk reward where your stop at least above this level of 98.73, probably in the 98.85 level, and so you're risking 25 pips for a move down that could get you about 80 pips. It's a nice risk reward to start the week out. The Great Britain JPY and slowly, gradually moving lower. It had the spike lower after the FOMC minutes, and then it has been consolidating, but it is trying. What we're going to watch for is a break of these FOMC minute lows, and if we get that, we could get a move down to 123.20. If we get a break higher, though, of, say we set a higher high, because you can see it's setting lower lows, if we get a break of the 123.57 level, we could get a push higher, and then you would look for your targets to be the 125 level. 125 level, and you can make, that would be definitely a really short-term scalp. You can make 40 pips, and then you could look for a push up towards the 150, 125, 48. So the risk reward isn't that great there, but if you want to make a short-term scalping trade, you could go that. So you'd be risking about 30 pips to make 40 pips. It's better than one-to-one risk reward. It's just an opportunity, an idea out there. Maybe not the best. Just throwing it out for you. The odd JPY, as you can see, once after it broke its trend line, it has had quite a good move now. It broke it at 82.89, and it went all the way down to test the 81.50 level. So if anybody took that, they could have definitely had 140 pips right there. And that was on the that I put out as one of the trade setups that you can look on the blog. I put trade setups every once in a while of trades that I find in interesting positions in a longer term. Just suggest, like, it's not an exact replication. I'll just put nothing's an exact replication. I put the chart out and then and show you the levels and let you guys look at it during the week and see if you're and if the opportunity ever comes for the possible scenario, such as the break, you could take the trade. The way that you would have traded this one is not the initial break here, because it could have easily broke back up. You wait for the break. I would have waited for this trade right here for the pullback and the retest, and then you have a very defined risk reward, and you don't have to worry about getting gapped out on a quick move down and a rebuff higher. And but currently, right here, right now, we have resistance up at 82.20 and supports down at 81.50. This pair is going to obviously trade with the Aussie, and the Aussie has broke trendline support, so we could see the pair continue to move lower. But what we're going to watch is I'm going to watch for a move up towards the 82.20 level. If we get that, you could have a chance to go short there and look for a move down to 81.50. I wouldn't have much confidence in the short term. For a hold at the 81.50 level, the pair could continue to move lower into the even before the Jackson Hole meeting. Let's check the New Zealand JPY. This has been a difficult pair to test at best right now, because it hasn't really had any momentum going to either side. We still have the same pivot zone, 64.40, 64.80, but the pair has made a false break to the top and the bottom over the last few days. I mean, if you wanted to, you could go short here at 64, but to be honest, I don't see any edge trading this pair at the moment, so I would stay on the sideline. The CAD yen, this was an interesting trade. It's definitely one we took last week. One short right here. One I took last week. One short right here with the break of the trend line. Sold at the bottom here, and now it's just been consolidating. What you're going to watch for is a break, confirmed break of this trend line here. Around what 78.90, or and that could lead to a test of 78.50 and then move lower. But the more likely trade heading into the information this week is that we're going to base around these levels, and we could get a move. Any move down to 79 actually might be a better buying opportunity for a gradual move up higher towards the 80, back up to the trend line towards 80.50. So that's it. That's a rundown of the majors and the yen pairs. So what we're going to look at is we're going to be watching for consolidation into the beginning of the week, and I don't expect any giant moves, especially on Monday and Tuesday, where we have to watch out for rumors and for any data that's going to throw things off, such as the GDP report from the USA, and I believe that's on Wednesday. All right, everybody, enjoy the rest of your weekend. Let's make some pips this week, and remember to keep your trades keen and play it safe.